it's been fortuitous that this export market has opened up at the same time.
Kathy, one thing I want to ask you, and we talked about it at the beginning, inflation. Your mentor, you and I talked about this just a few weeks ago, Art Laffer, you were in your 20s, you were focusing on the economy. It was a time where inflation was off the charts and everybody thought it would consistently stay that way. Laffer thought differently, and we know, well known in the supply side economics. Here we are at another time where the markets, the volatility is often guided by our inflation expectations. Is inflation going to be a problem in your view?
Well, we've been saying for some time, actually since the depths of the coronavirus, we were doing YouTube videos saying regularly, V-shaped recovery, businesses are way behind consumers. Consumers are buying all of these goods. In fact, that's all they can do because they're stuck at home, right? So they were buying non-durable and durable goods that could be shipped to them, right?
Right.
Okay, that part of consumption is 1/3 of consumption, and a disproportionate amount or percentage of the market basket of consumers was in goods for the past year. Businesses didn't expect it. They were behind even before the coronavirus. They had been lagging in terms of capital spending, in terms of inventories. They were worried about inverted yield curves and China-US trade conflict. There were many, many concerns. So they had been dragging their feet. They got even further behind and still haven't caught up. So what's happening now? Double, triple ordering, maybe quadruple ordering, because they just can't get the goods.
Panic
especially
buying. We've been talking about companies panic buying too.
Panic buying. And so what I believe is we are setting up for a massive period of deflation. Now, let me explain that. There are three sources of deflation. One is when the orders, these double and triple orders, are canceled, right? Now, we have seen lumber correct 30% in the last week. I think this is the beginning of that. Copper is now starting to correct. And I believe that commodity prices went too far, too fast as businesses were scrambling and panicking, right? They were losing business to competition if they hadn't planned their inventories correctly. So that's one source of deflation, but that's only cyclical deflation. And we actually didn't expect it to start now. We expected it to start later in the year, but I guess it makes sense now that vaccines are here and consumers are shifting away from goods towards services or at the margin. The writing is on the wall. Those are double and triple orders are going to be canceled. Prices were too high, and we're probably going to see a drop in commodities. But there are two other sources of deflation out there, and this is what we've been saying for quite some time. One has to do with, it's a good deflation. It's caused by technologically enabled innovation. And we believe when you see DNA sequencing costs dropping 40% for every cumulative doubling in genome sequenced, or when you see AI training costs dropping 37 to 50% per year, these are massive deflationary forces that are going to hit every part of the economy. AI is going to be everywhere. So that's good deflation. Now, what's bad deflation? Bad deflation is going to hit those companies that are going to be disintermediated and disrupted by all of the innovation that we talk about all the time, based on DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. So companies who have leveraged up to satisfy short-term oriented shareholders who say, I want my profits now, I want my dividends now, so they buy back their shares, they haven't been investing enough in innovation. They are going to lose. If they're not lucky, if they are unlucky, they will lose their businesses.
So, Kathy, what I like about you is your consistency, and we have been talking about these themes, right, for a long time. Having said that, your performance has been really consistent. It's been a tougher year this year, and you've had flows out of your funds. I was tracking just, I think, over the last week, it's almost $1 billion. So, how do you keep your investors kind of energized in your philosophy and your thinking and your outlook and confident in your strategy, in a moment where there's a lot of doubt out there?
Yes. Well, a couple of things just in terms of flows. In our biggest outflows were in March. There are a lot of commentators out there, shall I say, screaming about how ETFs would have to, or our ETFs would have to shut down, which is impossible. And they just don't understand the ETF infrastructure surrounding us. It's a beautiful thing, let me tell you. The flows are no problem. Our spreads have not moved. But anyway, beyond that, um, what has happened is our price targets for the next 5 years, that's our investment time horizon, have not changed, right?
At all. Not at all. Yeah.
Not, in fact, some of them have gone up as quarterly results have come out. Now, they're not going to change that much because that one quarter's result is not going to change a 5-year price target by that much. But the forces that the coronavirus put in motion, supporting all of the innovation that in which we invest, they are not looking back. And so what we are seeing is, a 30 to 40% discount to peak prices in February for the same price targets. So we're looking at this saying, all right, on sale, innovation is on sale. And oh, by the way, the bull market has broadened out. It is now embracing value and more cyclical stocks. So what has happened is the bull market has broadened, has strengthened, and that is usually a launching pad for our next move up. This happened, if I can just say, 2016. Same thing. Fourth quarter of 16, after Trump, against all expectations, was elected, value stocks took off because we're going to have a big cycle, tax cuts, right? And our strategy went down. We were negative. But what happened was 2017 was one of our best years ever, save last year. And that's because the bull market had broadened out, included value, cyclicals were taking off, and the economy was on the mend. Our economy is very strong right now, and cyclical earnings growth and revenue growth is a competition to innovation. But if we're right on what's happening with commodity prices right now, and that's going to be extended, that is the ticket to the next move in our kinds of stocks.